Hi, everyone. My name is Allie Johnson, and I'll be moderating today's webinar. I'll begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our wonderful guest speaker, Nimaj Driscoll. He's a business credit coach with our partner Nav Technologies, Inc., and he'll introduce himself, take us through a presentation on credit building for small businesses. As we go along, please feel free to ask questions using the Q&A function. We'll respond to them during the presentation. For any questions that we don't get to today, we're happy to address through our no-cost one-on-one services or connect you with resources that can help. I'll share a recording of this webinar and the slides as part of a follow-up email. So, what is the Capital Pathways program? It's a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We'll start with a program overview, then go through program eligibility, and finish up with an outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses and nonprofits build the systems and habits needed to become capital ready. This matters because businesses and nonprofits that are less prepared can often self-select out or fail loan applications. These early failures correlate to a lack of adequate capital, and higher cost alternatives often don't build long-term capacity. Ultimately, only about half of the loan amounts that are requested actually reach small businesses. So to put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, only 20 to 30% of those who apply actually get their loans approved. So to address this challenge, Capital Pathways creates a path to financial and legal readiness, and our program offers an immersive, hands-on group experience paired with one-on-one support. Who's eligible, you may ask? Very small businesses and nonprofits at any stage who face challenges accessing traditional financing. The services we offer include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and of course, credit building advising. We start our process with a self-assessment that pinpoints your business's key gaps so we can connect you with tailored resources, either through our program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we partner with a law firm that can help with more complex topics related to business registration, trademarks, and contract and agreement reviews. We also offer financial webinars on topics including financial basics, financial statement preparation, and QuickBooks training. Our one-on-one tailored support covers business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, loan readiness and lender preparation. And this loan application readiness services include both webinars and one-on-one individualized support. Those webinar topics cover things such as what lenders look for in loan applications, interactive mock loan interviews, SBA loan options, and sample application analyses. We also have a partnership with a lender that offers one-on-one support for those looking for capital. After today's webinar, the next stage of our Credit to Capital credit building program is to schedule an intake call for our one-on-one advising. During these one-on-one sessions, your advisor will work with you to review and interpret your business and personal credit reports and build an individualized credit improvement plan to strengthen your credit and help you qualify for better financing options and terms. You can register for the intake call through the link in the QR code currently on the screen, or you can reach out to me directly at capitalpathways@virginiasbdc.org. I'll go ahead and share my email and the link in the chat for everybody to have. Now I'd like to shift over to introductions. As I mentioned before, my name is Allie Johnson. I'm today's moderator and serve as the program and intake coordinator for the Capital Pathways program. I have a professional background in economic development, small business support, and access to finance projects both domestically and internationally. Our session today will consist of a 90-minute presentation. Again, feel free to ask any questions throughout the presentation using the Q&A function. We'll respond to them as we go along. Any questions that we don't get to today, we're happy to address. There are no cost one-on-one services or connect you with those resources that can help. As I said before, I'll share a recording of this webinar and the slides in a follow-up email. I'd like to now pass things over to Nimaj, introduce himself and tell us a bit about his background and start the presentation.
All right. Thank you, Ali. My name is Nimaj Driscoll, business credit coach here at NAV. Let me go ahead and start the presentation here. So again, Nimaj Driscoll, business credit coach at NAV, a certified credit counselor and financial education instructor. Today I want to welcome everybody. We're going to have a great session. We will be talking about the connection between credit and access to capital. So my goal is to help you understand what your credit reports mean, what credit scores and financial documents, and just how to communicate to lenders before you apply for funding. All right. So our phase one module. So as you can see, we'll be getting into a lot of detail today. We'll be discussing consumer laws and consumer rights, the things that protect you, just where the credit score originated, your personal credit scores, reporting and monitoring so many different ways to receive credit information these days, and the link between business credit scores and reporting and how your personal credit influences that. So the first phase here today is going to really begin with basic credit laws. So you're right. So as consumers, we have consumer protection laws, and these things give us the ability to work with credit in a way that is more protective because it can be difficult when you are receiving phone calls or you were denied for unjust reasons, or maybe you didn't have the opportunity because you were um, um, maybe you didn't have a certain opportunity because of some sort of discrimination or things like that, right? So it's really the focus on this is to understand that it's a regulated system. And this affects your access to not just loans, but housing, access to vehicles, access to business funding. So there's four major laws that we're going to be going over. So the first is the FCRA.
Nimaj,
Very important.
sorry to interrupt, but we're not seeing your slides.
You can't see my slide? Okay. All right. Is this better?
Much, thank you.
Okay, well, thank you for letting me know. So not to rehash everything I said, but this session today is designed to be able to help everyone understand the link between personal credit, the foundations of it, how important it is, and it also influences business credit. But we'll dig into business credit and specifically business financing as well. But we can't do that until we start with the foundation, which are consumer credit laws and the history of the American credit score. We have all of these different type of laws. There's even more, but these are the key ones to really hone in on. We have the FCRA, the FDCPA, so the Fair Debt Collection Practices Act, our FACTA. So you'll start to get good with these acronyms. FCRA doesn't have a really a fancy acronym that just rolls off your tongue, but the FDCPA, the FACTA, and the ECOA, the ECOA, Equal Credit Opportunity Act. So you don't need to memorize every single detail, but you do need to know that these laws exist to protect accuracy, to protect fairness, privacy, and identity protection, equal and accessible credit. So let's start with the FCRA. Very important. So this act regulates credit bureaus like Experian, Equifax, and TransUnion. These are the three personal credit bureaus, consumer credit bureaus. So we'll dig into that more. The key takeaway is that you have the right to access your credit report. You have the right to dispute inaccurate information and to receive notice when information is used against you in a denial. Moving forward, we have the FDCPA, the Fair Debt Collection Practices Act. So this act protects consumers from those abusive and deceptive debt collection practices. So, I don't know if any of us attending today has ever, been in collections or had some sort of debt that, they were on the hook for, right? And sometimes you get those phone calls and those unreasonable hours, and or people who call and misrepresent who they are, or communicate with you because it may not always be a phone call or discuss your debt with unauthorized third parties. So you have the right to request debt validation. And that's what this consumer protection law is all about. Collectors cannot harass you. So when you cite the FDCPA, this will, give you the right to request debt validation. The next key law is the Fair and Accurate Credit Transactions Act. Okay, so FACTA. This is to strengthen your identity theft protection. So it's very important. So identity theft is something that runs rampant. And FACTA is here to protect us from this. So this is where your free annual credit reports come into play. Your fraud alerts that we see. So we have fraud alerts on our credit cards and our debit cards and on our bank accounts and all these different mechanisms to alert us and keep us aware, of potential activity. Um, just rules around protecting sensitive financial information. So for businesses, this also reminds us that our customer data must be handled securely because our customers, through extension of our business, can also be at risk if we are not handling and stewarding their data properly. So this particular law covers that. And the last key law that we're going to discuss today is the ECOA, the Equal Credit Opportunity Act. So this says that lenders, they can't discriminate based off of several protected characteristics like race, religion, sex, origin, marital status, age, public assistance, public assistance income per se. So this is a very strong law that exercises, our consumer rights. Lenders need to make decisions based on credit worthiness. All right. Your ability to or projected ability to pay back, not who someone is. So this protects against those disparities. All right. So now we're going to get into the Fair Credit Reporting Act that started in 1970. All right. So we can see the history of these, laws are not really that old. They've been around for, several years, but it's not as old as you may think. So the key functions, regulating the bureaus, making sure that we as consumers have access to our credit reports and can dispute it. So whenever any of you have done a credit dispute, you're able to do so because of the FCRA. So this is why things report to our credit reports, which is much different than the way business credit reporting is. So we'll get into that a little bit later, but just remember now, your consumer credit reports because of the FCRA, and then you'll learn why business credit reporting reports the way it does because of laws or because of the lack of law. So you'll see which one, fits pretty soon. Having incorrect data on your credit report, having that removed or having like limited access to your credit file. So when you think about your report, being frozen or those type of things. So you are able to get your free credit report on on annualcreditreport.com. So one thing to know is that during the pandemic, we actually have been allowed to get our credit report for free once a week. Okay, so they changed that actually. So it's no longer just once a year. So you have access or more visibility or more frequency. You do have a 30-day investigation requirement after dispute, and you must be notified when your credit is denied. So if you get not just getting an email saying that you were denied, but you have to get some sort of letter that says that you were denied and has to state at least one reason why. So this is what an adverse action notice is. So adverse action. The FDCPA, just in more detail. So now I've covered the overview, so let's dig into it. So harassments or threats, so threatening phone calls, as you can see. If you get called too early, then that is a violation of this right that we have as consumers, which started in 1977. If you get called after 9 p.m., so sometimes those collectors may not convert time zones well, or they're doing it intentionally. But regardless of whether the intent, if the outcome falls in this, then you have the right to request this to stop. Repeated calling or calling repeatedly to annoy you. False representation. So this is a big one. So people are pretending to be, lawyers or officials or those who have perceived authority, which, is definitely against the law, and discussing debt with unauthorized third parties. So people who don't have the ability to speak on your behalf. So with credit, with personal credit, it's all about authorization. You have to provide authorization for a lot of things to take place. So these are your consumer rights. All right. So you have the right to request debt validation within 30 days. Okay, so this is, who does this debt belong to? At what time was this debt taken out? Basically proving that this is your debt. So you have that right. And you also have the right to demand collectors stop by contacting them in writing. So, paper is, although a lot of things in writing these days are seen as more archaic or old school, all right? But definitely writing letters and these things are your best forms to protect yourself or to enact some of these laws that we have here. Then we have the fair, excuse me. So we have the Fair Transactions Act. Okay, so what does it provide? So it gives you free annual credit reports and fraud alerts. All right. Identity theft protections. So you ever notice that when you apply for something or pay for something, and you take a look at your receipt, you'll see that it's just the last few digits. So the truncation of debit card numbers on receipts is due to this law. So it's actually came about in 2003, and it's an amendment to the FCRA just to help reduce identity theft and improve overall accuracy. The disposal rules. So there are rules and laws and things that require proper destruction of these, sensitive materials. All right. And also impacts businesses the same way. So businesses need to protect their, most important data is their customers' financial data. So we've seen or may have even been victims of data breaches and all of those things at some point or another, right? It's hard to escape it these days. Well, secure document disposal is required as well. Okay. And then lastly, we're going to talk about the ECOA, the Equal Credit Opportunity Act of 1974. So as we can see, ensuring fair credit access to all. So it's really about discrimination. Lenders should not be discriminating based off of our race or color, our religion, our age, origin, where we're from, our gender or sex, our marital status, uh, income that we receive if we, are on public assistance or ever had that at some point. So you're allowed to exercise your consumer rights. So one of the key protections that come from this is the adverse action notice. So lenders must provide specific reasons for denial so you know that you are not being discriminated against based off of these things that are protected. All right. So lenders they have to make decisions on credit worthiness and risk and the scope of credit as well. So let's dig into, personal credit. We're going to be talking about how business owners, especially startups or newer businesses, personal credit is going to matter tremendously because as an owner, you're often going to be asked to personally guarantee, debt that you're looking to take on. So just to zoom out a little bit, let's talk about some of the mechanics. So credit, what is your credit score? Because there is a difference between your credit score and your credit report. All right. So it's a very important distinction. Your credit score is a snapshot. It's just one number at one particular point in time. It's calculated from the report. So the data that's on the report computes into a score. It's a specific moment of time and it reflects your current risk level. So not the past, not the future, but where you are for that particular time period that this credit report was pulled. So your credit report is the full story. So lenders, they not only do they care about your score, the number, they want to understand the behavior behind the number. All right. So this is your full historical report. You're going to see things like your accounts. So all of your accounts. So on in the business credit side, accounts are called trade lines. On personal credit is just your accounts. So your payment history, very important. Your balances, how much do you owe? Your public record. So have you had some issues, paying things back in the past or any type of pending, or not pending, but judgments or liens or those type of things that will be seen more as derogatory. And just your long-term history. So how long have you had credit? So your personal credit score is based off of all of the information that you can see here. It's being used for decisioning. So lenders make loan decisions based off of what they see. They determine your credit risk. So if you are have a higher risk of a credit report or a lower credit score, then they're looking at, well, what's the likelihood of you defaulting, which is essentially, not being able to pay back whatever money that you borrow. Okay. And there's a different score models. So the longest standing score model, the one that's used most popularly for lending, especially, is called FICO. All right. Now, there's also the Vantage score. So these are the themes that you can see here are really around payment history, utilization, the length of time and credit behavior overall. So in plain language, do you pay on time? How much do you owe? Are you carrying and managing debt responsibly? So it's very important to see that for the FICO score and Vantage score, typical score ranges start at 300, they go to 850. So at the top here, the FICO model weighs past payment history very high. So out of everything that they categorize, your payment history is number one. So please pay your debts on time. Anything that shows up on your credit report, it must be paid on time if you want to maintain the highest credit score. All right. The second piece of it is at 30%, which is your outstanding debt. Okay. So how much debt do you have outstanding total? So this is when you get into that cumulative, balance. All right. So what do you owe? All right. So that is the next thing. So if you can limit that, you still have to show that you have experience with debt, but the operative word here, it's outstanding debt. Okay. The outstanding piece of it. Okay. How long have you had credit? So that lends to your experience. As you can see, that's 15%. So not as big as payment history, not as big as outstanding debt, but definitely relevant. So that's your credit age. So when you look at your credit report and you see credit age, this is what they're referring to. This is what the FICO model goes by. New applications for credit. So those are inquiries. So everybody's favorite word. People love to talk about inquiries, but as you can see, inquiries are actually 10%. So it doesn't mean that you should apply for, 100 credit cards in a row and expect that that is going to help your credit in any sort of way. But at the same time, you missing payments is going to damage you in a very material way. All right. So that's just important to put in perspective. Types of credit that you have. So this is your credit mixture. Do you have revolving credit, which is a credit card? Do you have installment credit, which would be like a car note or a mortgage? Do you have different variations of, revolving or installment credit, revolving lines of credit, student loans? What shows up on your credit report, and are you responsible with secured and unsecured credit ultimately? All right. You can have a secured credit card, you can have an unsecured credit card. Mortgages and cars and vehicles are secured by the assets themselves. You can have an unsecured loan, which would be an installment loan. All right. So that's also important to know too. Your Vantage score. So the Vantage score is a newer model that weights things a little bit differently. So as you can see, your past payment history is at the top. So it's pretty equal there when it comes to payment history. But the next thing is going to be the credit age and the percent of credit used. So we can see certain things move up the ladder and move down a little bit. So all in all, if you do the right thing and use credit responsibly, you should work to having, I don't want to say equal scores, but you're going to have good scores in both categories. All right. But just everyone on this Zoom today, on this webinar, keep in mind that FICO is what's most commonly used. This is what's used in lending decisions. So this is what you want to pay attention to. So when you have your apps and things like Credit Karma, or maybe if your bank gives you your credit score each month, start to really pay attention. Is this FICO? Because it's going to be branded. It'll say FICO. And if it's not, then it's more than likely a Vantage score, which still gives you a lot of great data. But just know when you're applying for things, your FICO is what's being evaluated, not the Vantage score. All right. So, what are personal credit reports? Personal credit report is the document behind the score. So think of the score as the grade and the report as more of the transcript. So it shows the history that created the score. So that's what your report is. Personal credit reports is a record of how you've managed credit in the past. So it's all rear looking, it's all backwards looking, okay? And lenders use past data or historical data to help them predict the risk that they may be taking on in the future by lending to you. All right. Lenders use your personal credit score to see patterns. So this is all pattern recognition, whether obligations were paid on time, how much debt is outstanding, how long things have been open. If you've had negative circumstances, was it an isolated event? Did it just happen one time? Or is this something that happens habitually? So that's a very important thing to think about, because sometimes you may have a situation to where you had a health issue or lost a job, you had a temporary setback. Well, sometimes those things can be explained if you are working with a lender that evaluates those things, right? But if this is a constant thing, hey, I'm late on my mortgage every single month, I'm 60 days late on my credit cards, then that's more of a spending or behavior problem, which signifies a higher risk. So your credit report reveals who you are, how much debt you've had, and how long you've had it, how frequently you apply for credit, which are again your inquiries, how much credit is available to you. And let's back up to the frequency in which you've applied for credit. So applying for credit too much can also signify that maybe, something is going wrong. Are you having a cash flow issue? Are you, what's your reason why you need credit so much? So in your mind, you may be thinking, well, hey, I'm just trying to see if I can improve for the best credit card out here, right? Well, lenders look at it as just like, why does this person need money? And are they showing signals and signs that they need money a little bit too much? Are they in dire straits of what's going on? So the perception of inquiries is really something to understand. Now that you're on this webinar here today, so that's important takeaway for you. The why behind the what. How much credit is available to you? How much are you using? Again, usage versus limit. So that's important. So the lower usage or the lower the balance that you carry, that's going to be better for you. All right. Are you using whatever limits that you have all the way to the max? And are you paying these things down? So what patterns do you showcase? So that's also important. And of course, timely payments for your credit accounts. Paying on time is what helps you get stronger credit and building a track record of that. So whether information is negative about you in public records, bankruptcies, foreclosures, all of those things. So to have a clean credit report, you want to limit the things that can be seen negatively and control your spending and control your usage and control what shows up on your credit report. So that's what it reveals. So now we're going to get into the three major credit bureaus, which are Experian, Equifax, and TransUnion. So once we get into business credit, you'll notice that a couple of these also play in the business credit space as well. So what are the bureaus? Their job is um, to use your credit reports. So they create the credit reports and they share that with you, but they also share that with, public records and regulators and lenders and all of those things. This is the data. These are the data centers, for your credit. So start to think of it like that. So your scores can vary depending on which report is pulled, which model was pulled, and other factors that influence this. So as you can see, TransUnion may have a scoring or algorithm that might lead to different scores than Experian or Equifax. But the core of what's on the report should be the same. And anytime you see differences in your credit reports as far as the information that's there, then that may be, an opportunity to dispute, right? So personal credit report information. So most personal credit reports contain four major categories. We're looking at personal identifying information, PII. Then we have credit history. You have inquiries and you have public records. So when your credit report is being reviewed, you want to make sure that your identity information is correct, your accounts are accurate, and any negative items actually belong to you. Because if something negative is on your credit report and it's not yours, then you should definitely dispute that because there are errors that happen frequently in personal credit reporting and in business credit reporting. So your personal information. So don't be shocked when you see that they have maybe your spouse's name on there if you're married, or, the previous employers that you used to work with. So all of your information follows you. And sometimes this information is correct or outdated, which can be disputed very easily with each credit bureau individually. Your credit history, again, as we talked about all of these things, inquiries and public records. So how to access your free credit report. So you're entitled to your free credit report through annualcreditreport.com. You want to check regularly before applying for credit. It's because you want to prepare. So you have to prepare. That way, if you know what's on your credit report, then you'll know what whoever's accessing and reviewing, evaluating your credit report will more than likely see. And then you can request your free credit reports at the same time from all three credit reporting agencies. So that way you have a time to correct errors and just prepare yourself before that the time actually comes to where you need to access capital. Right. So now we're going to go into credit monitoring options. So I lightly touched on this earlier, but there are credit monitoring tools out there to help you keep an eye on changes. So the great thing about having apps is that you'll be able to get alerts, you get push notifications. So a lot of this stuff will happen in real time. So that helps you stay on top of fraud and making sure that things are, accurate as they happen. They're useful for alerts and trends. But remember, your score may not be the exact score that you see, may not be the exact score that the lender uses. So that's important. So as I mentioned earlier, start to pay attention. Is this a Vantage score model or is this a FICO score model? And there's so many FICO score models as well. But generally, that's how you want to know which is which. And again, lean on the side of FICO because that is the most common in the lending industry. So you use this as a monitoring guide, not the final authority, but more of a monitoring guide, and that's the best way to position the different monitoring options that are out there. All right. So when personal credit history is important for your business, so this is extremely important. So when you're a new business, you're often going to be asked to personally guarantee or co-sign a business loan. So it's about liability and responsibility. So primarily your business is going to be the first layer of defense. But if you're brand new, or even if you've been around for a while and your business doesn't have that track record or hasn't earned that credibility financially, oftentimes, you as the individual will be the backstop. So that's what personal guarantee means. It's basically saying that if everything goes bad, you are now responsible for whatever outstanding debt there is. Okay. So when you apply for things as a business, oftentimes your personal credit will be evaluated in addition to your business cash flow, your business performance, in addition to, or sometimes in addition to your business credit report. So if you're seeking maybe supplier credit or credit from one of your vendors, or you're looking for financing for a growth opportunity, you want to get equipment, or maybe you need a little bit of working capital, or a simple credit card, your personal credit will often still be assessed. Sometimes it doesn't always result into a hard pull. Sometimes it's just, you're a soft pull, so they can just get an idea as to where you sit. So just be comfortable knowing that. So that means that your personal credit is something that you can't escape, and it's always going to be just paramount to make sure that this is as strong as possible at all times. So it's never something that you abandon and switch when you start to focus a little bit more on your business operations. You want to be doing both. It's a both and, not an either or. All right. So if your business does not yet have deep credit history, or very strong and consistent financials, the owner's personal credit is often something that gets looked at. All right. So now we're heading into module number 3, business credit scores and reports. So the difference between personal credit scores and business credit scores. All right. So personal credit scores are usually based on consumer credit reports. All right, they have similar score ranges, as you can see, 350 to 850. Business credit scores use a wider variety of systems to measure different factors on a company's credit, and even outside sources, public records, payment history, a variance of information that business credit scores are created by. So, business credit scores. This slide really gives you a good visual or example on the scoring systems. Dun and Bradstreet. So when you see DNB, that's Dun and Bradstreet. Dun and Bradstreet is actually the original business credit bureau. So their credit score is called a paydex score. It's focused heavily on vendor payments, vendor payment history, supplier payment history. This goes all the way up to what actually goes up to 100, but that gold standard is 80. You can achieve higher than an 80 if you make those vendor supplier payments early and have a strong track record of paying early, but 80 is that gold standard. So that's where you want to get to when you are establishing a paydex score. So again, this is all business credit. So you need a DUNS number to obtain a paydex score. So everyone here, if you have not applied for a DUNS number, this is your credit identifier with the Business Credit Bureau Dun& and Bradstreet. Then you want to go to Dun& and Bradstreet's website and fill out a account, create an account, and apply for a DUNS number. Okay, so that's how you get reporting to start. The next one is going to be Equifax. So Equifax has, several models. So this one we're showing here is their, payment index. It goes from 1 to 100. So similar to Paydex, just predicting the likelihood of severe delinquency or business failure within 12 months. So how likely will you be around? So they have a lot of different data based on your industry, revenue, stability, the credit that you have, a lot of things to determine the likelihood of you staying around. Okay. So this is a very important score. So naturally, the longer you have credit that Equifax recognizes, then one of the biggest things is that this score, would tend to get into the higher ranges because you are lasting, you are outstanding, the length of time, right? Or standing the test of time. Okay, so that's important. And then lastly, the Experian IntelliScore Plus. So this looks at payment trends like trade lines and public records and just other risk indicators. Business credit has more than one score, not one. These scores, have their, good, great, excellent ranges as well. Yeah, I tell everyone if you have above a 76, you're in good shape. Once you crack that 80 range, then you're considered, excellent. And then that can go up to 100. It's not common that I see people that high, but your credit score, again, like on personal, it says one thing, but ultimately your business performance is the thing that's going to help you get approved for capital. So that's very important to know. Credit scores influence decisions, but your performance, what your business has sold, what you've done, what your profit looks like, what your cash flow looks like, is the main thing that drives the decision. All right. So business credit reports. So similar to personal credit reports, they give you information that lenders can see about your business. One major difference is really privacy. That's like one of the biggest things. Personal credit is more private. Okay, you have to give authorization. You have to unlock your credit, often if you have it frozen or you have a lock on it. Business credit or business information is public. Okay. Personal credit, you can get your personal credit report for free. Business credit reports actually cost money and it's public and it's open to anyone that purchases your credit report to review. So that's a huge differentiator. So you have to know that when you really think about the importance of monitoring your business credit because it's more accessible for people to see. So this includes all of your identifying information, business credit history, registration details, financial information, business background. All of these things are on your business credit report. So let's jump into phase two. So our phase two moves from understanding credit into applying for credit.
Before we do that, we do have a couple questions. Do you mind if we pause for a question session?
Yes. Right,
All
right.
right. First question is the asker has an Experian business credit subscription. Does this mean that lenders should be using that instead of the asker's personal credit?
All right. So your Experian credit subscription gives you your experience score, which is going to be a FICO score. And depending on the description you chose, you'll have access to TransUnion and Equifax. So it's less where the subscription is coming from because there's different subscriptions that can give you these, but it's more about is it the FICO score? All right. So if you're getting it directly from Experian, it's the FICO. And that is what lenders are looking at. Just know that depending on what you're applying for, they could be using a different model within FICO. As you may start to notice, you may see FICO 8. So that's like the general score that you see. But there are FICO 2s and FICO 5s and different things depending on if you're applying for a car or a mortgage or a credit card. So that's really getting into the details. But to answer your question, if you have the Experian subscription, then you are pretty safe if that particular lender is looking at your consumer experience. That's what they're seeing.
Thank you. Next question is, how do you find out what your PAYDEX score is if you already have a DUNS number?
All right. So now the paydex score. So this one is interesting. So when you review your Dun and Bradstreet credit report, a paydex score is only generated if you have at least two accounts or business credit jargon, two trade lines that report to Dun and Bradstreet that you have at least three payment experiences on. So what are payment experiences? But three payments. Okay. So it takes a little bit of time to generate a paydex score for one, so you don't get one just straight out of the gate. But once you do get that, then you'll be able to see that on your business credit report from Dun& Bradstreet. Or if you are subscribed to NAV, we give you access to all three of your business credit reports, in which you'll be able to see and monitor that on a daily basis.
Thank you. I had a follow-up question from that first one, clarifying that the Experian subscription is a business subscription, not a personal. So does that impact which credit score lenders would be looking at?
Okay. So now on the business side, it's really up to that particular lender, vendor, or business credit issuer as to what bureau they look or pull from. So if they check Experian, then they will see what you see when you look at your Experian business credit report. Now, you getting approved is going to be much more intricate than just having a certain score. Yeah.
Thank you. We
Mhm.
have no more questions in the queue, so let's look
All
into
right.
phase two.
All right. Thank you. So let me jump back on in here. All right. So now we are in phase two. So phase two, we talked about understanding credit, and now we're talking about applying for credit. Okay. So we'll cover what credit matters when seeking capital, how to build and maintain good credit, and what lenders look for in applications and how to analyze personal and business credit reports. Module four, why credit matters when seeking capital. So credit matters because it directly affects how lenders perceive risk. So the emphasis, perceive risk, how they view things, the lens that they're looking at you through. The stronger your credit profile, the more options that you'll have as a borrower. The weaker your credit profile, the more limited or expensive financing can become. So you have less options. So it's important to put your credit positioning and business credit positioning in a really strong place so that you can access different types or have more flexibility or easier process in going through an approval or application process. So lower credit scores, as an example, higher risk, and you may be denied or have higher interest rates. Higher credit scores, more favorable loan terms. And loan terms are very important. And so let's dig into the nuance a little bit. So sometimes you may get approved and you might celebrate approval, but if you are getting approved for a weekly repayment term, and that is going to put some significant pressure on your cash flow, then usually that's due to something credit related or income related. So having a stronger credit score gives you the ability to have a monthly term, depending on the type of financing that you're applying for. So let's really get into personal credit and business credit and how they, work together. So credit matters because, like I said, it affects, perceived risk. A stronger the credit profile, more options that you have. Um, your personal credit score is going to be heavily factored in based off of your debt to income when you're applying for any type of financing on the personal side. So lenders, tend to view 650-ish credit as, comfortable. Okay. 700 credit is going to be a stronger borrower. 740 plus is top tier. So there are credit ranges. So it's important to know the ranges for what's considered good. All right. So example, if you are 670 to 739, that is considered good, but you want to be on that 700 plus side of good. All right. And then once you go beyond good, then you're at very good, which will be 740. So that's that top tier credit. And then you get excellent credit. That's in the 800. So just I glossed over that just so you can put all of these things in perspective. So the credit score ranges and credit score band are important to know as well. What's a good business credit score? Business credit scores can range from 0 to 100. They contain a lot of like business history and public record information and just, more firmographic. So just information on your operating company. So as we mentioned earlier, Dun and Bradstreet is key. The paydex score 80 plus, it means you're paying on time. If your score drops below that, more than likely you've missed a payment, you've been late, or you've been late beyond whatever term has been set. Experian, their IntelliScore, 76 to 100 is considered lower risk. So as I mentioned earlier, 76, once you get about there, then you're in that lower risk category. The higher you go, even lower risk. Does that mean that you'll automatically get approved if you're in that range? No, but it means that you are lower risk. Equifax, the payment indicator, payment index, excuse me, 80 to 100. So again, that means you're paying the things that report to Equifax on time. FICO SBSS. So this is another score that SBA lenders use. So again, this SBSS, the Small Business Scoring Service, it goes from 0 to 300. If you're in that 161, 165, 190 range, then you're considered to have better credit. And then if you can jump above that, then that's considered excellent. So that just opens you up to more financing options. All right. So how to build and maintain a good credit score. So the fundamentals are, straightforward. Pay bills on time, keep your utilization low, and if you need to consider secure credit, it's okay. Like secure credit can help you build or rebuild credit when you're just starting out or coming out of a situation to where you may not have done right by the credit that you were extended in the past due to whatever that may be. So become an authorized user only when it truly helps, and then monitor your credit for errors or signs of misuse. So becoming an authorized user, it can allow you to benefit in a very surface level way on someone else's good credit history. So but any lender that's really assessing your credit report, they're going to look at the credit that you have and then the credit that's authorized users. And they know that if you only have one or two accounts in your name, but everything else is an authorized user, then they're going to say, well, hey, you still haven't shown enough proof or history that you can handle debt, regardless of you riding on somebody else's credit. So it helps in a very service level way. What I mean by it can, jump your credit score up a few points, but approvability comes from more than credit score. So that's really my theme throughout this. So that's why doing all of the right things helps you have the strongest foundation if you are looking for capital, whether it's personal capital or business related capital. Also, it you should monitor your credit risk. So all important things to know on how to establish good personal credit. All right, so this is my favorite. Build and maintain a good business credit score. So why should I even establish business credit? Business credit matters. Can matter more to lenders. Emphasis on can. Okay, so suppliers may review your credit history to determine if they want to extend you deferred payment terms, like net payment terms. So when you hear net 30, net 60, net 90, that is a deferred payment term. So you have to pay the full balance within the number of days that they're extending you. So net 30, pay within 30 days, pay within 60 days, 90 days. Sometimes you can be rewarded if you pay sooner. You may get discounts and things. And also this can help influence a stronger paydex score because oftentimes the Dun& Bradstreet credit score is influenced by supplier and vendor style credit. Um, I mean, also your business credit, report and scores and things are used to verify just legitimacy. So your own customers will oftentimes, look you up and say, well, hey, is this company legitimate? Should I even do business with this company? So just from the optics perspective, your business report is very meaningful for that because again, this is public record. It verifies your legitimacy, and then also insurance companies use your business credit report. So think less about the score, think about the report. What does the information on my business credit report say about my business? Do I look legitimate? Do I show that I've been around for a while? Do I show what type of industry I'm operating in? What lens is someone going to view me in? And do the vendors, lenders, credit issuers that I pay, that I work with, do I pay them on time? Do I pay them on time within net 30 or am I paying them 5 days late, which is net 35? And then when you're beyond those terms, that negatively influences your credit score. So all of these things matter. So they're assessing your character from your business credit report, which is a slightly different set of data or a different lens than how it's applied to your consumer credit. So insurance companies will determine your risk level and how much you pay in premium. Stronger report, your business insurance, has the ability to be a little bit lesser in their premium scale. This one is very important, procurement officers. So, opportunity to work and execute government contracts. So, the government wants to make sure that they are taking on strong businesses to, execute on their contracts. So, that's why it's important. So, you always want to be ready and have strong positioning because you never know when an opportunity may arise that your business may take advantage of. And, I left lenders for last because most of us focus on, well, if I have a strong business credit report, then I'll get access to lending. So this is something that, most of us commonly think about, but we think about less about the supplier and shipping or procurement opportunities or insurance, or even just making sure that we look legitimate and safe for potential customers to pay us, right? So these are all things that are important. So I'm saying lenders last because, they may use your report to determine financing or approval terms. So just know that that can, be something that's evaluated as well. It's not the only thing that's evaluated, but it does come into play depending on who you're applying with and what you are applying for. All right. So build a business credit score. So as we mentioned earlier, apply for a DUNS number. Now to go deeper, Dun& and Bradstreet is actually the only business credit bureau that you have to apply for a identifier for. So the moment your business has credit that is extended to it that actually reports to Experian and Equifax, they will create these identifiers for you, and theirs have different names. So don't worry about that. You don't have to create one with those two. You have to do this with Dun& and Bradstreet. Make sure you have an EIN, so your employer identification number. This is what you get from the IRS. So having these two things is what helps you get started and gets established as a business on paper. Okay. Uh, so check existing history. It's important. So you're able to search for your company on reporting agency websites. So as I mentioned, it is, public record. So you as the owner, you can go to Experian, you can search for your company, and you identify yourself, and it will give you some basic information on your company. Then you can pay for your credit reports, but Nav will give you your credit reports. So that's one of the benefits of using our service because we compile it all in one place. And it's often very cost effective because business credit reports are not cheap. The next thing is establishing reporting relationships. So this is real world business credit use. So I love this because this gets doesn't get talked about as much. So sometimes we think, well, hey, or we've heard, on the internet and places, hey, I need to work with these particular vendors or suppliers because they give you a trade line. Well, yes, but the better yes is moving away from just those who sell office supplies and different types of goods that you may or may not need to working with your true suppliers. So say, for example, your construction and you have a company that you get roofing materials from. Well, if you have been spending money with them doing roofs, you want to find out, well, hey, do you offer a vendor or supplier line of credit? And if so, guess what? They're going to check your history, check your business credit report, look at some other factors to determine if you are approvable. So if you get a line of credit from your supplier, now you're able to do more and pay that back usually on net payment terms, net 30, net 60, net 90, or whatever. So your credit report becomes a track record that you're building, not just to establish a score or establish credit, but to use it in a way that helps you establish real world relationships. So that often gets lost in this. So in this webinar, you hear it first if you haven't paid attention to that before. Next, just building and updating your history. So regularly update information and check for accuracy, correctness. Your financial statements, make sure all of those things are accurate because business credit bureaus, they pull a lot of data from a lot of places that you wouldn't expect. There, and that information is what feeds the foundation and the background of what's creating your business credit report. So it's one thing to think about, okay, well, my score is influenced based off of, what my balance is, what I spend, who I pay on time, but it's also influenced on that financial data that exists. So when your financials are correct, then that lends to just having a more complete credit profile. All right. So best practices for building strong credit. Payment discipline is super important. Payment discipline is super important. One of the biggest things when you pay your loans, bills, taxes on time, and see, paying taxes on time, taxes don't report to your credit, but guess what? If you don't pay your taxes and you have a tax lien, guess what? It will report negatively. So everything is not a, well, did it report? Did it report? You want to make sure that things that don't report negatively because you have avoided or maybe just had some issues that you didn't really work to resolve immediately. So that is what shows trust. Okay, so it's extremely important to pay your obligations on time. Um, Business information, you want that stuff to be consistent. You want to separate your business and personal finances. Have a business account for business finances, for business transactions. So if you are getting paid into your personal account, then you are not operating as a business. There's really no way around it. So establish a personal account. If you have a business account and you're paying your mortgage from it, stop doing that. Okay, that's called commingling. So your personal transactions should stay in your personal account. So that separation is what makes you a business and what makes you appear to be operating a properly run business. So that's very important. And things that I'm saying are things that I've seen throughout my lending career. So these are real world examples. I've done a loan for someone who was paying, and this is my former before NAV. Of course, we're not, a direct lender, but nonetheless, they're paying their mortgage out of their business credit account, their business bank account. So that's a no-no. Don't do that. Credit acquisition and monitoring. So obtain credit in the business name and then monitor, both your personal and credit history. So these are just some of the key best practices that you want to focus on. Okay, so the next slide here is from credit to capital, what lenders are looking for in your application. So credit matters, but lenders also want to understand the full picture. Got some questions here?
Yes, we have one question in the queue. It's
All right.
what trade lines should a business owner have when they're working on a transportation company?
Okay, so I'm gonna stop sharing here. I'll come back. All right. So thank you for asking that question. So I love the phrasing that you use because you're relating it directly to your industry. Okay. So it's not the amount of trade lines, but it's the usage. Because if you have accounts that report and you don't use them, then they become inactive, would actually hurt you. And if you don't use it, you don't get the benefit from establishing a relationship. So as a transportation company, I had to say that first. So as a transportation company, you have to think about, so what are my daily expenses? All right, you spend a lot of money on fuel as a transportation company. Therefore, you should have some sort of dedicated fuel card. So I always lead with that because it's easy to swipe a business debit card or a general purpose business credit card for fuel. But a lot of business credit cards don't report, and business debit cards absolutely don't report, right? So if you get a business fuel card that reports, you've created a trade line and you have separated expenses only for fuel. That's also going to help you later on when it comes to your accounting. And if you have a fleet and other drivers, you can have controls set up to where they have their card, sort of spending limits and things like that. Another thing that may be good as a transportation company is you may experience some times to where um, you get paid a little bit slower than when you produce the work. So it may be good to have a line of credit. So a line of credit is more of a type of loan, but if that loan reports, then that becomes a trade line. Office supplies. I tell everyone office supplies are great for everyone because you always need things to do business, and those things often get overlooked. So for your home office, your physical office, the common everyday household essentials should also be purchased as well.
Thank you.
Right. All right. So getting back into the presentation here. So module six, from credit to capital. All right. So this section is where we connect credit to the loan application. Credit matters, but lenders want to understand your full business picture. What is your repayment ability? What is the loan purpose? Very important. Documentation. Does the request make sense? So right now we're looking at the right lender for your business. So big banks. So big banks are going to give you the best terms, the best interest rates, and the best loan terms. So remember earlier how I mentioned, sometimes you might get approved, but you get offered a term that just is too rigid. It might be too short. It might not be long enough. The frequency to repay might be a little bit more than what your business can handle. So when you're working with a big bank, you usually get better outcomes term wise. So banks often focus on larger financing needs and loan amounts. They can be less accessible to, newer small business owners or small business owners who haven't, established a lot of historical financials. So, strong tax returns, or if you don't necessarily have a profit and loss statement or balance sheet, a lot of times banks are looking at those things. All right. Then you have your medium banks and credit unions. So this is where, things get a little bit more accessible. Your local credit union, or if you have a regional credit union or things like that. So they prioritize, good credit and relationship, and they help you with medium-sized loans and also, offer pretty favorable terms. Then you have your small banks and CDFIs. So these are, yeah, even more skewed towards, small and underserved entrepreneurs, those startups, those who have lower credit history or just more microloan options. So I actually started my career in SBA lending and CDFI lending. So CDFI is Community Development Financial Institutions is what that acronym stands for. And you want to check to see if CDFIs exist in the area in which you live. Oftentimes, if your credit is a little bit imperfect, but you have something going on and you're able to, use the forward-looking approval metrics. Like sometimes your financials might be in good shape or decent shape, but your projections or the use of the funds is going to help your business grow. CDFIs value those things, especially if you're doing things that are community focused. Extremely important, the five C's of credit. All right. So this is an essential factor what lenders use to evaluate you. So they look at your character. So commonly the character is your repayment reputation, okay, your credit score. Capacity is your ability to repay. But before we get into capacity, I want to focus on character a little bit more. So that's your track record. So track record, think what's on paper. What's on paper is your credit report, your history in repaying debt. So the theory, well, not theory, but in practice, if you haven't paid back things well in the past, what is the likelihood that you will be able to handle this new debt moving forward? So that's why it's very important to have a strong credit report because it gives you more options and there's less questions for you to have to respond to when you've had, negative circumstances. So that is what they look at. So you can have high personal character, but you just maybe mismanaged credit or had a circumstance that required you to forego paying a bill or so. And that doesn't mean you're a bad person, but that's just what the lenders are looking at. So if you're working with a loan officer, a lender, a bank, a CDFI, and they really dig in and find out, well, what happened, then that's a great relationship. And that's somebody you want to use because they can use their judgment to help determine, okay, well, this is something that's not continuing to happen. We think we could move forward and then focus more on your capacity. So this is the most important, see the capacity. That's your ability to repay the loan based off of your what? Your income and your existing debt. All right. So when you are borrowing money, the bank, CDFI, whatever institution is saying, hey, well, can this business pay back what they are looking to borrow? And if your use of funds are ever questioned, which sometimes is not, but if your use of funds is questioned, so hey, what are you using the money for? Does it make sense? And does that make sense for the type of business that you operate in? And in a forward-looking sense, will this have the ability to help you pay for itself? So is it tied to revenue generation? Is it tied to growth? So if you are buying equipment, does this equipment allow you to produce more or provide a service or something that you're currently not, which helps you make more money, which helps strengthen the repayment capacity? So based off of the current business performance, and then sometimes what the use of those funds being borrowed is for. So it's very important. If you can't pay it back, and if the numbers don't pencil out, oftentimes we don't have an approval. Capital, so it represents the borrower's assets and net worth, financial stability. So, how liquid are you? What money do you have, in your business bank account? What are you in a positive net worth situation or a negative net worth situation? All of these things are weighted a little bit differently depending again on who the lender is, what you're applying for, and what your use of funds are for. So collateral. So most of us are familiar with the idea of collateral. So securing an asset against a loan. And this provides lenders with assurance in case of default. So in the event things don't go as intended, they want to make sure that they have some ability to get repaid. So this is going to be either blanket collateral, so just the things in which the business owns in general, or maybe even the collateral that's securing the loan. So say for example, you are looking to start a food truck. Well, if you're looking to start a food truck, and you're borrowing money to get that truck, so better believe they're going to be using that particular trailer or truck, the vehicle itself, as collateral. But your capacity still is what pays back the loan. So you can see collateral is going to be more of a secondary thing. So they're not making a decision to approve you if you have, weak capacity or aren't showing the strongest credit, just because they have something to be able to sell in the event the loan doesn't get repaid. They're looking to see, can you pay it back? And as a secondary source, do we have something to keep us to be able to have some sort of recourse, even if we can't become 100% whole? And then conditions. So the loan, the conditions really consider a lot of different factors, economic factors, environment. So we think of tariffs and all of those things. So those things affect the supply chain and pricing and costs and all the way down to us being able to create or sell the goods and services that we have to our customers, and thus they pay more for it. That's just a quick, easy, relevant example. So all of these things together, so not any one thing in isolation, all of these things help determine the likelihood of loan repayment and are crucial, absolutely crucial for building just a strong business profile and credit profile. DTI, debt to income ratio. So DTI, this particular term is more of a consumer credit term. Business credit or not business credit, business financing has a similar term, debt service coverage ratio, which is essentially the same thing or very similar. So totally monthly debt divided by gross monthly income. So on the business side, you're looking at more so the total monthly debt divided by that net income, because your net income is where new expenses come from, right? Which would be the loan that you're considering taking out. But they also may look at you personally. So what do you look like personally? So how much money do you have coming in before taxes personally divided by, your total monthly debt? So what is those payments, the individual payments, not the total sum, but those minimum monthly payments? Okay. So we use this or lenders use this to assess whether the borrower can support payments if the business cash flow is limited. So before you contact lenders, number one, check and improve your credit. So you need to know what they will see so you can have a better conversation with them, or just, be more expecting of the outcome that you may get. So it helps you research your options a little bit better as well when you know where your personal credit stands and what makes sense for you to go after. So you can have great personal credit and apply for the wrong type of financing that's more geared towards someone with average or poor credit. And you might get the best option that they have, but even their best option may not be your most optimal. Okay. So those are little things that I see business owners do in the real world because you say, well, hey, I got good credit, so I'm going to I'm going to try to get some capital that's really quick and fast and easy approved, but it may not be the best structure. But you may have been better to take the time to apply with a bank or credit union or even a different means of credit format to where you have more opportunity. So that's a different way of looking at it. Okay. So you also need to know whether, a loan, a term loan, a line of credit, micro loan, a SBA loan, or another product, you want to be able to research your options. So that's very important. Also, use loan calculators to understand the total cost. So one of my favorite loan calculators is from Bankrate. So this is something you can do. You can Google Bankrate business loan calculator. And this will be able to show you in a very simple, so easy to use. Hey, I think I need $200,000 in capital. All right, great. 200,000. How many years? Okay, so I'm probably gonna, put in, I don't know, maybe 5 years on average. What is the interest rate gonna be? I don't know, let's say 8%, 10%, right? Then you can see it spits out exactly what that monthly payment is going to be. So it may be a little bit of a sticker shock for a lot of you who are considering borrowing and don't know what that monthly payment obligation is going to be. So you have to build that into your financial projections, build that into your planning, so you can look at what your expenses are and if the business can comfortably support that throughout your business cycle. All right, so that's very important. So, all in all, arm yourself with as much info as possible, and that's how you move from having, building credit to utilizing credit in the most responsible way. Okay. So once you've identified the lenders, now you want to think about the things that you have to provide. So what documentations should you collect? Most lenders need the same things. So especially if you're working with a SBA guaranteed lender, any type of a government guarantee program, they're going to want all of these things, right? So let's take a look at what we have here. So a presentation to the lender with a loan request. So this is going to be just the outline of what you're asking for. What is it supposed to do? What information regarding your business, more so like a business plan or outline. Financial projections. So typically 3 years, some want 2 years. Okay. So if you were to get this capital, where does this take your business over that span of time? What do you expect your expenses to be on a month-to-month basis or annual basis? And, on a monthly basis, what are your revenue? Is your gross revenue going to increase or decrease? Are you going to have slow periods or seasonality? All of those things need to be reflected in your financial projections. So, how is this money going to help you grow? And that's what your projections show, year over year, looking forward. Okay. Typically 3 years, 2 to 3 years is usually what's asked for. Personal financial information. So you may fill out what's called a personal financial statement. So what is your personal income? If you have a outside income, a job, a day job, or some other, type of income. Okay. What are your assets essentially versus your liabilities on a personal level? So that gives them a snapshot of how liquid you are. Do you have savings? So all of the things help them determine, your approvability. As a business, information on your management team. So oftentimes your management team may have some experience that you don't have. So you may be the center of the operation, but you have a key manager that brings those several years of retail experience, that's going to be needed if you are starting a business or applying for capital for a retail business, right? So if you don't have that, somebody on your team needs to have that. So it's very important to have that, basic bio or resume or things on the people who are on your team because collectively you guys are all personally guaranteeing or are part of the loan decision. All right. So that's something that's not often talked about. So that's very important. Additional information for established businesses, financial statements, very important. So just get comfortable with it now. Your profit and loss statement or income statement is extremely important. So this says, hey, how much am I bringing in? What does it cost to provide my product or service? What are my expenses to do business after that? And then lastly, what is my profit? Okay. So new debt comes from your profit. Okay. So that's how they equate that. So if you have enough profit to be able to absorb the debt that you're looking to potentially borrow or finance, and still have money or cash left over to where you're in a comfortable threshold to still operate and sustain your business, and your cash flow is still strong, then that's how you get approved. Your balance sheet, what you own as a business versus what you owe. So your physical assets, cash assets, your liabilities, loan payments and other things that you have to pay, and then the equity that you have put in or are retaining as the business owner. Okay. So your net worth as a business essentially is what your balance sheet is a snapshot of. Then, of course, your cash flow. So your cash flow is, the money that's coming into your business, how frequent, and that is what is paying the bills. Okay, so profit doesn't pay the bills, cash flow pays the bills, but profit determines if the total operation has the capacity to take on debt. So think about it that way. Business and personal bank statements. Your business bank statements are absolutely important. They tell a really important story about your business. So if you have a seasonal business, and you're looking at bank statements and you see, well, hey, I only have money coming in from for 5 months out of the year. All right. Well, that may be something that a lender has to structure around. All right. So, because again, if you have a fixed payment term, you have to pay for that for 12 months, every single month, regardless if you have a slow season or not. Your bank statements are show the stability of your income. All right. So are you generating sales on a consistent basis? Do you have a lot of dips, ups and downs? I made 10,000 one month. I made 1,000 the next month. I made 3,000 that month after that, 50,000 after that. So although cumulatively it may look good, but on a monthly basis, that can be looked at a little bit risky, right? Or at a higher level of risk, even though the sums of money are there. So it tells a whole lot about how you spend, how your money comes in. Are you commingling? Does your business perform as a business that it should based off of the type of industry that it's in? So it gives you a lot of detail, and your bank statement should back up what's on your P&L. So if you're saying, hey, I'm grossing this year, to this date and time in the year in May, I've grossed 100,000, but you only show $1,000 a month in revenue, then your bank statements are telling the truth and your profit and loss statement is probably incorrect. So just make sure that all of the information that you have is accurate and that you're basing it off of real data, which is why bookkeeping is very important. Questions?
No questions in the queue just yet, but I do want to acknowledge that we have about 5 minutes left in the scheduled time.
Okay.
So for the next few slides where we go through kind of the documents for startups and established businesses, if we could just give kind of a summary of them and rather than necessarily going slide by slide or document by document, I'd appreciate it. For our participants, we do have, or we are able to finish out the slides. We have until about 2 o'clock if folks are able to stay on. If not, as I said, we will be providing a recording of the presentation and the slide deck in a follow-up email.
All right, thank you. All right, so just in summary, be ready to answer those questions. What are you using the money for? And are you willing to pay it back with collateral and a personal guarantee? Because those things will be brought up and you want to be ready for it. So, again, presentation for the lending outline. who you are, who your customer is. You have to know your customer. Are you business to business? Are you business to consumer? What are you offering? Okay, be clear on the product that you're offering and what you need the money for. How the sales are sales made? Are they made right there on the spot? Are they made online? Are they, contract based? Do you have net payment terms? So how do you get paid? Who your competition marketing plan is, and ultimately summarizing all of that will give you your ask. So the business information that you want to make sure that you have here is your EIN, your articles, operating agreement. Got to have that, business licenses and permits, business lease or property ownership documents. So if you're looking to do some tenant improvements to a space, then you have to be able to furnish a lease. As a quick example, a business plan is very key. A lot of small business lenders, especially like CDFIs or SBA lenders, they're going to want to look at your business plan with the application. These are the key components. So it should be a summary of all of the things that are needed to be able to operate a business in which you are more than likely borrowing money to grow. Okay. So from who you are to the owner, what your company does, down to the products and services you sell and how they're priced. Any trademarks or IP that you own or have, how you communicate with customers, and your sales strategy, how the business makes its money. Right. So SBA lean business plans, if you focus on these things in this slide, you create a very lean business plan. This is enough. You don't have to overcomplicate it, but you have to have information in all of these key categories in which you'll be able to get once we share this presentation with you. So financial projections, again, I mentioned earlier, 2 to 3 years. First year is 12 months, detailed assumptions. So the explaining how you got to the numbers. All right. That's extremely important. So that's a little bit of narrative. So if you say you're going to make, $100, well, how many of these particular things do you have to sell to get there? And what particular revenue items will you be selling to be able to achieve those numbers? So let the lenders into your brain, because just reading numbers cold on paper doesn't always give the big picture as to what you're thinking. Income and assets. So we talked about the personal financial statement. So good news is I'm ahead of a little bit of these things on the slide here. Information on your management team. Okay, so your cash flow statement, income statement, balance sheet. Again, this is what the core of what's being evaluated. How much money is coming in? How does it come in? Where does it come in from? And then what does the business own? Very important. If anything, understand your cash flow, because your cash flow does what? It pays the bills. Your sales come in, and then your cash flow is what pays bills. Cash goes out to pay expenses. Cash comes in. So that continuum has to be strong, predictable, and consistent. 3 to 6 months of bank statements. I already told you why that's important. This allows them to confirm your cash on hand and identify the source. Where is it coming from? If your money is just coming from your personal checking account, when that's not a business transaction, nobody paid you. Okay. So the source of that, they should be able to see that it comes from sales and not just owner injection, owner equity. Tax returns, the last 2 to 3 years, make sure they're filed. Make sure that you are optimizing your credit, your return, not just for deductions, but if you're looking to borrow, then your net income, your NOI, is going to be a very, very important number. Module 7. So just how to read your credit report, hard and soft inquiries, understanding negative items, all of these things that we discussed. I think most of us now should be more prepared to read a credit report that looks like this. What does a summary look like? Accounts in good standing, your personal information. So this is that, front page that gives a layout as to who you are and what you owe, and how well do you do with it. Notice your credit report doesn't contain a score. All right. So this is more so for data validation. And this is what you get from the 3 credit bureaus when you get your credit report. Are they current? Do you have public records? Have you applied for credit recently? So you can have negative items, delinquency, collections, open 30, 60 days past due. So as you can see, the things in red here are all negative accounts. So if things are inaccurate, you want to dispute it. But if it is accurate, then you want to, work to have some type of payment arrangement so you can at least show that responsibility. So for your businesses, as example, all of these things are key in making sure that your information for your business is correct. Credit scores, your score rating. So your business credit report may have more than one score. So take note that all scores that are listed in the report, and then that's how you know what's showing up. Same thing, make sure your information is correct here. Is your business name right? Is it spelled properly? Is the DBA on your credit report or is it your actual legal entity? Is the industry code or business type right? Corporation type, the name of the owner. Do you have negative information on your credit report? All important. If you paid off something, it should show a zero balance and not that you still owe it. All important things. So as you can see, identifying and disputing errors, data validation, data validation is key, right?
Alrighty. Thank you. That last bit went pretty quickly, but again, as a reminder, folks will be sharing the slides so they can look at it for themselves and email us with any questions. Um, in the meantime, Q&A is open for questions, so please use that to send them our way. We have one in the line, and it's how do we get a business to report the credit bureau to their credit bureau? Excuse me. How do we get a business to report to the credit bureau? As an example, the question asker operates a corporate housing and furnished rentals company, and they pay a small local professional cleaning company. What would the asker to need in order to get the cleaning company to provide payments to the bureau?
All right. So that's a great question. And it's important to start with the reason why this happens, which ties into the laws. So consumer credit laws, the Fair Credit Reporting Act requires personal credit, consumer credit to report. Businesses don't have the same laws. They don't have any of that. So this is the reason why a lot of the different types of credit or things that we may have been extended as business owners don't show up because there's no law requiring them to. So it's up to that particular lender, vendor, or credit issuer if they choose to report or not. So if you are so the cleaning company that you're working with, um, if they are a vendor of yours, if you are buying supplies from them and they aren't reporting, well, it's up to them. So they have to make that choice, not just for you on an individual basis, but is this going to be part of their business practice to report? So businesses typically don't pick and choose who they report for. It's either they report or they don't. So that's something that they would have to take up with the particular bureau that they would consider reporting if they choose to. Um, in addition to some larger companies, they may not report for smaller scale businesses, but they may report at the enterprise level. So if you are a very large corporation and you're doing a lot of business, then it may be worth it to them to report.
Thank you. And I just put up the QR code to schedule intake calls for our one-on-one credit building advising, which is the next step in the credit to capital PAT program. But in the meantime, we have a little bit of time left if folks want to ask their questions. Namaj, do you have any kind of FAQs or common pain points that you've seen as an advisor that people may bring to you with regards to how do they improve their credit score?
Yeah. So oftentimes the biggest thing that I see or get asked is how do I improve my personal credit score? And what's overlooked is having a mixture, the right mixture of credit. Okay. So with personal credit, you have revolving credit, which is your credit cards as a prime example. And then you have installment credit, as I mentioned earlier, which may be a personal loan, a secured loan, a car note, a mortgage, things like that. So if someone has a very what's called a thin credit profile, they don't really have much going on, much to be evaluated, but they have one personal credit card, what's going to help them actually is going to be able to establish a credit in the installment category. Okay. So getting some sort of secured loan, and these are very easy to get, right? So you see this on different banks. There's different fintech providers. Your local credit union or bank is really the first place I tell anyone to go. Because again, banks usually give you better terms and you build relationship. So having a secured loan or some sort of small dollar amount, $500 loan or something can help you. So if you don't have credit in enough credit in the categories, you won't have a strong score. You'll notice you kind of stall out at a 650, or you're like, well, why can I never get beyond this? Because you don't have enough. Or you are all installment and you pay cars well, but you have no revolving. Okay. Or you don't have enough revolving. Okay. So start to look at it from that perspective. That's one of the things that I tell people when it comes to your personal credit and your payment history is extremely important too. And then also just watching your utilization. Um,
Thank you. That was very, very helpful. So I'm not seeing any more questions in the queue. I'll give it another minute or two for folks to drop them in the Q&A. Um, but barring that, I think we can close our time together. Thank you everyone for joining us today. And thank you, Namaj, for this informative presentation. Again, if folks are interested in continuing with the Credit to Capital program, please go ahead and use the QR code on the screen or the link that's in the chat to schedule a one-on-one or an intake call rather for that one-on-one advising. You can also reach out to me at the email address that's in the chat. It's capitalpathways@virginiasbdc.org. We're happy to answer any outstanding questions or things that pop into your brain at 3 in the morning. Alrighty, I'm seeing no more questions, so I think we'll close it there. Nuaj, thank you again.
you. Thank you, everyone. All right.
All right, hope everyone has a wonderful day.